want to, thank everybody for coming today. We have a great panel here. We have some more folks that are going to be straggling in here. I'm Ron Mazurski, and Ron is me. I'm the founder of Nyca. I'm also a board member and officer. We've been around for about 20 years, and we run monthly meetup events, and those meetup events include various topics that our members have told us they have an interest in. And we continue to have in-person events for a year, and 8 a year we have events that are virtual. So we'd like everybody to tune in to those events that you have an interest in. Each of our events seems to differ quite a bit based upon what the topic is. Our attendees, maybe 20% of them come to all the events or many of the events. Most of the events have new people each time, which is wonderful from a networking perspective. I do this not for the money, because there is no money. I do this because of the interest, the education, the meeting of new people. I find all of that pretty stimulating. We are a group of senior executives in payments, fintech, and banking, and we meet up on the topics of interest to the majority of our folks. We are happy to hear from you as to what other events you would like us to put on for you guys. And so please be in touch with us as we move along. Just a couple of introductions. I'm going to ask these guys to stand up. First, the board of directors of Nyca. We've got David True. David is here. Stand up. You're not following. You're not following. Thank you. Deb Baxley, Brian Bunkowski. Where's Brian? There we go. And me. I'm standing, so I don't have to do anything different. We also have some of our events committee members here today. We have Michael Elliott, and who has helped put this event together, and Stu Levine, who has, in the back here, who has also helped and done a yeoman's job of pulling this thing together. We're happy to engage with any of you after this panel and in the future. If you want to ring any of us on LinkedIn or call us or meet us afterwards, we're happy to have that discussion. We have upcoming events in May. We have Who's Behind the Transaction, Digital Identity, KYA, and the Rise of AI Agents in Payments. And we also have one in June on merchants managing payment expenses, something like that. We also will have an event on stablecoins that we are pulling together for later on this year, as well as an event on cross-border payments, which will be in October somewhere, maybe here, maybe somewhere else, but that will be an in-person event. That'll be done with in partnership with Convera. And I want to, David or Deb or Brian, any guys have any comments or things you want to mention?
The one thing I'd say is serendipity is the stuff of life. I got that on my LinkedIn profile. And serendipitously, I met, where is he? Eric Hazard. Right here. Back here. A while ago when he was working with a different firm. And that has led us to them graciously hosting in their fantastic space these events. And like Humphrey Bogart said to Claude Rains at the end of Casablanca, I think this is the beginning of a beautiful friendship.
Well, thank you, David. You just stole my next line, which was thank you very much, Eric. And thank you, Caroline, for... I thought I would take a breather after introducing you guys. And Deb?
We should point out the newest member of our events committee, Rod is here.
Rod. Rod, who is not yet in the inner circle. Please sit down and be part of our inner circle.
I benefited so much from my friendship with him.
He's a sage, yes.
And I think on that note, we're going to turn to our panel to kick this event off. Just so everybody knows, one of our panelists, I'm not going to try to point out, but Hans Mars will need to take off. He's got something else conflicting at the end, so don't worry if he gets up and walks out on us. Nothing personal. But now, now you know. And I'm going to ask our moderator for this event, Grace Broadbent, who is a senior analyst at EMARKETER. She's senior analyst in payments. to pick this up. She'll go through the introductions, who's on the panel, and take the questions and everything else. From 6:45 to 7 or so, we will get together, and she will continue the panel with any questions and questions you guys have, and the panel will be really happy to answer along the way. I think that's it. Thank you.
Thanks, Ron. Good evening, everyone. I'm happy to be here. My name is Grace Broadbent. As Ron said, I am a senior analyst at EMARKETER. For those that don't know, EMARKETER is a go-to resource for product strategy and marketing professionals in financial services, among a range of other industries. We provide surveys, briefings, data analysis, benchmarks, you name it, to help people stay on top of trends and developments in the financial services industry and help them figure out what that means for their business. Really excited to be here today and lead this conversation. We're really going to answer a simple question is where investors think growth is going to be at the intersection of banking, payments, and fintech. We really are at an inflection point in fintech, with the zero rate market firmly in the rearview mirror. We're trying to figure out where are sustainable growth models versus what is really just hype. In addition, we have, a range of regulatory changes, a range of technological advancements from, AI, open banking, faster real-time payments, stablecoins, digital currencies. There's a lot going on, and we will get into a lot of it. So we have an exciting conversation coming up. Joining me on stage at the end, we have Hans Morris, managing partner at Nyca Partners. In the middle, we have Rodrigo Rodas, managing partner at A-Game Capital Partners, or formerly IDC Ventures. And then closest to me, we have Adam Hark of Wellesley Hills Financial, I want to start by letting everyone give a little deeper introduction of themselves to help us understand the perspective you guys are bringing to the panel. Hans, if you want to kick us off.
Okay, we are, as Grace said, a venture capital firm. We only focus on fintech. We started 2014. We're in our fifth fund. We have about $1 billion under management. I believe we do more enterprise fintech than any other firm. That's been a focus of ours from the beginning. Payments, my background, I was at Smith Barney, which then became Citigroup over my career, but I ran the financial service group there for about 12 years, and I was CFO for the institutional part of Citi. And then technology and operations reported to me for about 4 years. So I would say I know a lot about the spaghetti inside financial institutions. And I worked on a lot of payments and credit card and other types of M&A over that period. I then left and went to Visa. I was the president during the restructuring IPO of Visa. So that reinforced my understanding of what's really great and what's a problem. What are things you can compete against big companies in, and what is very hard to compete against big companies. And I was at General Atlantic for 4 years and headed their financial services group, but then started Nyca on the idea that there were, at that point, 2014, probably 500 or 600 fintech, VC-backed fintech companies, which was up a lot, but very few venture firms really were experts on the financial system. And I thought all these details really matter, and so that's why we started Nyca.
Wonderful. Rodrigo?
Well, tough act to follow. Thank you, Hans. Well, Rodrigo Rodas, part of Again Capital. We invest across different areas, mainly fintech marketplaces and digital platforms, focused in US, LATAM, and Europe. We have about $850 million in assets under management. And yeah, in terms of background, kind of fell into the fintech space. I ran a business I sold to a listed company here in the US that focused on, we did mainly subprime lending and some pawn activities in LATAM across 5 countries, about 175 locations, and went into fintech out of need at the time. I needed to remove cash from our systems. And, managing cash is complicated and dangerous, and in Latin America even more so. So that's how I got into the fintech space and implementing technologies to remove cash from that. And in a less purposeful way, I landed in VC.
Adam?
My name is Adam Hark, and I am managing member of Wells Hills Financial, which is a boutique payments and fintech investment bank. I think probably bring a little bit different perspective to this evening's conversation than my colleagues, just by virtue of us not being an investor, but working on and at the front lines of what's going on in the marketplace, especially the middle and lower middle markets, all species of fintech and payments tech that's out there. Our firm was designed in a way that it naturally captures a lot of young companies that are on the bleeding edge of banking tech, finance, payments, fintech. And so we have unique insight into a lot of the traffic that's going back and forth, what these companies are looking for, and who's out there, and what investors are looking for in terms of deploying their capital. By way of background, I am 22 years a banker. I think similarly, speaking very frankly, I fell ass backwards into investment banking about 22 years ago. It wasn't a career choice. I didn't go to school for finance. At the time, I was just looking for a career change, and there was somebody who was working for a merchant acquirer local in the Boston area. And this person was bird dogging deals essentially internally at the company, being paid as an employee. And he realized very quickly how painful it was to do all this heavy lifting of finding and diligencing, and the engagement and the management of the target. And then at the closing, he's sitting there and he's an employee on a salary, and then walks the banker and, walks out with the big payday. And he's like, I don't want to say most of it, but a lot of the work. I found that business model appealing because it has no ceiling, which was something I was interested in coming out of the hospitality industry, owning a few bars and restaurants in the Boston area. So my history is in payments, but over the years we've flattened out the practice, and even today we continue to grow. We recently opened up New York City. One of my managing directors here in the audience today, and we're opening up London as well this year. And I'm really happy to be here. I love Ron and the crew, and I think what he does here is wonderful.
Thank you all. So before we dive into some of the deeper trends, I do want to start at kind of a macro level of fintech investments. So kind of as I mentioned in my intro, when the zero interest rate environment stopped, it really exposed the hype from, what is resilient. So I want to talk about some of those models that were exposed as fundamentally flawed when the zero interest rate environment ended. Anything that comes top to mind?
Well, a lot of the businesses were not just payments, but many of the fintech businesses required capital to generate revenue. So you're lending money, you're insuring someone's life, you're doing, you're taking risk on a mortgage, like a put option on a mortgage. And so the once rates went up, all risk was reallocated, and many of those business models didn't make sense. So I think that was a pretty, vivid display of resorting out valuation starting in 2001, 2002, 2021, 2022. And I'd say since then, really over the past year and a half, I would have said that valuations were rationalized quite materially. There was a lot of very productive work. The companies became more profitable. They became much more capital efficient as well. And I think there's a good sorting out of valuations until first quarter this year, when they all were disrupted again by different risk factors. But I'd say, generally, if you look at just payments, some of the payments business models had a capital requirement. So some of the cross-border things. I don't know, we could dig into several of them where they were taking some sort of risk. But generally, payments businesses have been, they're now a very, very large. I mean, there's probably $1 trillion, maybe $2 trillion. If you take the private companies, with Stripe being the biggest, and just the big 5 companies, that's probably $1.5 trillion or something of market cap. So there's a very well-established mechanisms for valuation in that part of the fintech market.
Yeah, I mean, I would agree with that, where we see a lot of the payment infrastructure and a lot of this being resilient through that change. I think the interest rates are the best due diligence tool you had in that transition, as they came out and exposed. I mean, clear losers in this space were some of the interchange dependent neobanks. I mean, we saw Chime come out public like 50% from its high when it was private. Some of the lending businesses that depended on a very low cost of capital, low borrowing cost, unless you can be extremely efficient and have very low default rates and manage that properly, then you're going to be exposed. And so we saw a lot of that as well. And then finally, a lot of the businesses that really didn't solve a problem, but for one reason or another, you had a bunch of people sign up to them, even if the unit economics didn't make sense. So, I mean, to go back, we're seeing at least what we saw was evidence that the rails, the payment infrastructure, everything on top, everything you build things on top of, are, and I think will continue to be resilient.
So I thought this was when I looked at the document, the final cut, if you will, that you circulated to everybody. The macro questions caught me a little bit off guard. I think, from my perspective, when I think about the transition from low interest rate environment to higher, it was very much a structural story. Certainly, fintechs that in the lending space, specialty finance space, obviously very interest rate sensitive. I would make this comment, though, maybe answering the question a little bit differently or in a different way. I think coming out of the, on the heels of the exit out of the pandemic, is interest rates were still low. What I saw was a massive opportunity lost by the banks and a massive market share capture by specialty finance and private credit that slid right in there. And I think in large part, many of those companies who did create better decisioning models, better products, have really, they really came out winners from that transition, as opposed to identifying, I don't want to say the banks are the losers, but I think they yielded a lot of ground during that time.
And I think that goes back to a lot of, you have to solve an actual problem that exists, which Rodrigo mentioned. Great. So I do want to dig into one of our first trends today, which is stablecoins. Stablecoins, have dominated so many conversations over the past year or so. The market cap more than doubled in the past 3 years. Hype is exploding. But at the same time, usage of stablecoins from a consumer perspective, from a business perspective, is extremely minimal. So many hurdles, from regulatory hurdles still existing, technological limitations, fragmentation, consumer adoption, you name it. So I guess given all the hurdles, kind of how do we explain the hype that's created with what's the current reality? And where do you see near real-term value of stablecoins in the payment space? What are the use cases that really kind of will drive value from being, is it all B2B cross-border payments, which is kind of taking a lot of the noise right now? Do we see success in peer-to-peer payments? e-commerce payments feel like a stretch, but B2C payouts, things like that, kind of where your head is at with the, hype versus reality right now. Anyone can start.
You're from Latin America. You can. You can.
Well, it's
Well,
interesting.
that's a good use case. Is people who are willing to hold, want dollarization. That's obviously a good use case. Yeah.
Yeah, no, I completely agree. I mean, I think the interesting contrast there is for Latin America, a lot of it is either an existential need compared to a nice to have. So some of the examples that you gave, right? Argentina, I think, is the 15th largest country in terms of stable coins. And obviously, it's been a hedge against inflation and an easy way for people to retain value. At some point, we even looked at statistics from airline. People were buying points to hedge for inflation. I mean, buying airline points to hedge inflation, that's something. So we're seeing a lot of that. Argentina's doing. Brazil is doing great in terms of stablecoin adoption, especially on the B2B side. Their regulations have passed a couple, recently 519 and 521. The Brazilian central bank was way ahead of a lot of the other central banks. I mean, Roberto Carlos Neto, who's one of the most phenomenal central bankers ever, really paved the way for the B2B volume to escalate. And it's gone up, I think, around 60% year over year. And they're seeing some of that trickle down into individuals. I think in the U.S. it's a different case where stable coins, have been useful for example, for multinational treasury management. Could be, we're seeing a lot of B2B stuff there and treasury management. In terms of the consumer, Venmo works pretty well. I don't know, what I would need a stable coin for. Exactly. There's not a lot of incremental value there. The cross-border payments is a huge opportunity, but the on-ramp, off-ramp technologies make it very hard. And, there's regulations and there's barriers to entry in that space. So, that might take a little bit longer time.
Well, it's interesting. Venmo, PayPal works pretty well, but Venmo has integrated stablecoin payments into their service.
I would argue it's like,
I think I have two comments about this, which is almost all new payments ideas. One rule I have is if you're competing against existing systems, most of those systems actually function pretty well. So even if you say, cross-border payments, I have to go to correspondent banking, is a pain in the neck. I'd say, well, if you're a multinational corporation and you've set up your treasury systems, that is all pretty much automated. People say it takes 3 days to confirm. Not if you're, you're Microsoft and you're paying people. It does not take 3 days to confirm that. Dollar clearing is very cheap. It's basically part of your global banking package. Your per transaction cost, if you're sending hundreds of thousands or millions of dollars, is very, very low. And you have an integrated treasury management system that reports everything else and hedges it very efficiently. So I would say pretty much zero benefit from stable coins, except 24/7 confirmation, being able to efficiently move money. But the infrastructure to do all that didn't exist. You want to use stable coins, but you still need a lot of things in your systems to make it work. What I have seen, even in the past 6 months, 9 months, is a lot of that is coming together. There's tools now to do that. And there's some interesting applications, but it's nothing like when you listen to some stablecoin person advocate about it. Most of that is not true for corporate treasury. The things that works is I can send money real time, I can program it. If you're willing to just hold a stable coin, that's that is very, very efficient. The problem is stablecoins have no yield. There's no reason to do that. Most people don't want to hold a stablecoin. You have operational risk associated with that. Suppose that stablecoin goes bust. So there's lots of reasons not to do it. Consumers have zero reason to do it, I would say. Essentially zero reason to use stablecoins because, there's lots of personal operational risk, lots of complexity. A lot of that, I think, is going to change. But right now, the use cases we're talking about are someone wants to hold it. So Latin America is better than Argentine pesos or Nigerian currencies or lots of other stuff where you have extensive currency risk. Second, it is becoming, it's probably 10%, 12% of remittances now, maybe. And that's because you can do it real time and it can be pretty efficient. And it's really, remittance companies are using it as a way of moving money. The person sending and receiving has no idea really what's going on. It starts and ends in fiat. I think it's interesting to talk about Genius Act because many countries are now, I think, I don't know, like 33 or something. But there's now local stable coins. So Tanzania and Kenya have established local stable coins, not dollarized. So holding central bank or treasury currencies in that bonds in that currency, which then gives you an electronic receipt, an electronic mechanism, so you don't have to convert into fiat. You go into another stable coin, and there's exchange rate between the two stable coins. So there's fees, in effect, in that, but it's a lot cheaper than moving into fiat cash, and you can do it 24/7. So anyway, my view is this is changing rapidly. It's going to keep changing. But it's around the edges where there's something compelling not going at the core, is my experience.
Yeah, no, I agree that it's, again, you can't solve for a problem that doesn't exist. And if there's not really a real need for stablecoins to fix something that's already working, kind of why would consumers start using it? I do want to, the way I think of stablecoins is...
Can I push back on that?
Yes.
Not in the stablecoin sense, but I think where people should be looking now is what JP Morgan's doing, what BMO has just done, what SWIFT is running to catch up to the other two to do. That is the tokenized dollar. There is a reason. There is a use case, not so much for stablecoin, but for the underlying technology. And that to me is the story. That
was my next question.
Sorry for
no,
jumping.
I love this because my next question is going to be, I view it as like a three-way race. You have stable coins, you have tokenized deposits, or you have traditional real-time payment systems like Clearinghouse or FedNow. And they're all three kind of competing for the same volume. So how do you see that race coming out?
Well, to me, they are competing, but there are issues with two of them. RTPs and stable coins, and it was alluded to before, there are interoperability issues there, not just technological ones, but also regulatory and jurisdictional ones at both points, from where it's sent to where it's received. What's so fascinating about tokenized deposits is that it's being kept inside the banking system where there's a high degree of trust. It is not wildly decentralized, hardly so. Permission blockchain, you're getting all the benefit that people talk about if you were to use a stablecoin. But it's being done within the banking system, which people know, which they trust, which is arguably, even in my own personal experience with running my own firm, they're so much better at compliance and KYC and AML. To me, that's the one that people should keep their eyes on because that's where I see the underlying technology really starting to get traction.
Any other comments from Hans Rodrigo on deposits?
I would expect that right now, if you're a corporation, you have really two choices to send and receive money. Both involve bank. One is ACH, there's wires, and those, or no one really uses checks. Small businesses still use checks, but those now, I think you have multi-rails, which is expanding already. Push to card is a big one for many businesses collecting money. And, but I would say you're going to have, maybe, I don't know, 10 different systems, including different blockchain, different stablecoin regimes, which have different risk. And so I would say if I was a company, I'd want to be able to optimize. I want a system that optimizes for speed, cost, and risk associated with each transaction. And right now that system doesn't really exist because you just send instructions there's only one or two ways to pay, and the bank takes care of it. I see that changing. I think banks are going to do something similar. The regime that we talked about that exists now among banks is there's also a way to get your money back, which is essential to both consumers, but it's also essential. You're filling an invoice, and the invoice might have 6 or 7 participants in it in a marketplace, and something's not right. I need to reverse that transaction and complete it. Those rules don't exist yet, but that is all things that I think is infrastructure that is coming, and people are proposing all kinds of rules. Lots of organizations have proposed rules, but the good thing about the banks, there's just one set of rules, or Visa or MasterCard, there's one set of rules. And so you may not like the rules, but at least it's clear.
Yeah, I would agree. And I would say, these three, I wouldn't say they necessarily compete. I think you have a use case for each one of them. And these systems that we have in place now are going to evolve. So we are not going to, I don't expect, the underlying infrastructure that we have right now for payments, for example, we're seeing, the card schemes, Visa and MasterCard are planning and looking to catch up. I think Visa's stablecoin volume was pretty high last year. The largest tokenization is taking place in the credit card space. Although you're tokenizing assets, you're seeing a lot of this happen across the board. But tokenization is not, it's being adopted, but it's not something that's really novel. It's been there for a while. And these, for example, the card schemes are moving towards, real-time authorization. Eventually, they'll have to move to real-time settlement if they want to make sure that people keep playing with that. But one of the points Hans made, and you have a lot more experience than I do in that space, is it's interesting that we've seen is the rules that were built around these card schemes have been built over decades. And there's a lot of learnings and there's a lot of things that go into that. And when you see novel technologies like Pix coming out in Brazil, turns out like, oh, wait, we made it super simple, but guess what? Oh, if you do a return, you can't track that payment back to see what, who made it because of the way it's set up.
There's no payment ID.
So there's no payment ID. So if there's a return, it's a problem. So then if you're a business, then how do you manage returns? Fraud has been going through the roof to the point where some merchants that phased off accepting cards now are accepting them again because even though Pix was a lot cheaper, the fraud rates were so high, they'd rather go back and pay the interchange fees. So, I think we're going to see a lot of these things adapt over time. And I think the multi-rails is going to be where it's at, is can your underlying technology adapt to this? And I would say that infrastructure that needs to be built is one of the largest waves we'll see in the next couple of decades, because most of the infrastructure is very old, hard to move and adapt. And you just have to do it from scratch.
It's hard to scale without governance, and the card schemes have governance.
Absolutely. In the effort of time, we're going to change subjects. Okay, really quick.
Really quickly, this everybody should keep in mind that baked into that question, your question was a very good one. All these different technologies that you discussed, the three of them, these are all effectively debit products. Okay, they are not credit card products. So the card schemes do still have command over those types of payments. payments that are premised on a bank giving a consumer a loan or a business a loan. They're out of
Sure, I
scope.
don't agree with that. I think there's, you could have, or you could combine credit into any stable coin. And also, I think how many moves is one thing. Having credit or liquidity baked into the solution is important, but there's infrastructure being built around that too. You can, like the back end, I want fiat. Well, there's marketplaces being created to provide fiat. So I actually feel that that's something that will continue to evolve, and there's different models for providing capital at that point.
Well, we heard from Ron, Nypa is going to have a whole stablecoin event later this year. So we are going to pause this conversation to then, because it can't be a fintech panel without talking about AI. So we are switching gears, talk about AI. Again, a technology with an enormous amount of hype right now. We have to separate the hype from the reality. Do you think investors are dramatically overestimating near-term capabilities of autonomous financial agents? Adam, I made you have a short comment before, so if you would like to start.
Do I think investors are overestimating autonomous agents right now?
Mm-hmm.
I don't think they.
A large question, I know.
Well, I mean, they would have to be, because I think we're a long way away from those actually working and working well. That's a loaded question, because I think there are so many different elements to agentic commerce that need to be explored. And right now, what the market is doing is rushing to solve the technical piece to make it work. But there are really deep implications for that type of technology, not the least of which is I am, at this point in time, fully convinced that neither the consumer nor the businesses fully appreciate or understand the amount of access that they are going to have to fork over if you're a business and you have an agent on your side, and a consumer and you have an agent on your side. The amount of data or access you're going to have to provide those agents in order for it to be able to do what it supposedly can do, or what you want it to do, is incredibly vast. And I have serious concerns about small businesses in particular, whether they'll have they can afford to the cost of putting out and building and having structured data that an agent on their behalf can can plug in and communicate to an agent on the consumer side. And I also wonder, one of the other interesting areas too is, we keep hearing about if I see one more video of somebody saying you can have the agent plan your vacation, and they show the video and everybody's running on the beach. I'm like, listen, these LLMs are wonderful and they're super powerful. They're also super dumb. Okay. I don't have any problem saying that. The architecture, the real architecture that I think people should be paying attention to is the canonical knowledge engines that need to be built behind them, that the LLMs will have to sit on. Ultimately, the LLMs are going to be a UX. That's what they're going to be. But there's a lot to do there. So I think it's way out in the future.
And I'd say paying, one-click paying, is so easy. What's the incremental value of giving the payment decision to an agent? Would you rather just look at the options and click and pay?
I think it also goes down to trust.
Exactly.
Are you going to, and there's things that we don't even know yet. So if I have, say, an agent, and the agent does a payment on my behalf, and he makes a mistake, who's at fault?
Well, Target just said that. Target just said that, where Amex said we'll eat it all.
Until we have some sort of tort or some clever lawyer or something come out, and they'll play around with it, and you don't have the same CFPB you used to have before, but if you had it, probably a different story. So
it's going to be lawsuit palooza.
So I think there's things that will eventually get there. I think it's too early to say, what's there. There's things that are going to happen. Would I give agent access to my financial resources? Absolutely not. Sometimes they get stuff wrong. A lot of the times. these are models that are based on, it's all based on probabilities. It's all probabilistic. And there are things in life that are deterministic. That we can't use engine that, goes into that, onto this types of systems and looks at, okay, what's likely as opposed to what is. So there's things in that. And in terms of AI, like there's tremendous applications. There's things that we're seeing in terms of fintech specifically. I would say I want to take a look at businesses that are great and would be great without AI, but are better if AI exists. That's great.
Yeah, I think I agree with really all these comments, and I'd say that again, what happens first? We like focusing on where do you have expensive people doing manual tasks, and there's many examples in finance, and so there are lots and lots of good ideas. I see pretty much everything we do now is related to AI with some very really smart, motivated people building very compelling applications that may not be consumer applications yet, but there's a lot that's happening, and the economic efficiency of what they're building. We have many companies come in now with 8 people or 11 people and $3 million in revenue, and it's quite different. And I'd say I just had a whole string of board meetings the last couple of weeks. Every fintech company is rethinking what they're doing, and I feel if you don't have a very compelling AI story, you can't raise more money, probably can't go public. So it's going to change a lot, and I feel that a lot of that is actually quite efficient. It'll be quite good, but there's a lot that has to happen, as we've been talking about. Yeah, I think I'm going to take that as my cue to. I'm just furious with the reaction.
I love that
everyone's
closing
had.
thought.
Yes, exactly.
Thank you so
But
much
thank
for
you all
joining us,
for
Hans.
having me.
Okay, for the two of you I have left, I have one closing question, and then we're going to go to audience questions. This is again a loaded question, but what is one deeply held assumption that fintech investors are operating under today that you think is wrong? What would you challenge? Is it AI is overhyped? Is it, I don't know.
You can tell from the lack of response now that this was not a practice question. It's a surprise question.
Well, I mean, I think agentic is the obvious answer.
Mm-hmm.
I think it is overhyped in the sense that I think it's much further away from actually being functional and ticking all the boxes that it would need to tick for it to work for consumers and businesses and regulators as it relates to privacy and data access, the consent records, the intention, the new business models. I mean, there's so much unknown about it. I mean, that's the easy one. I'll let you pick one, and I'll see if I can come up with one more.
That's good. Anything you want to challenge, Rodrigo, from what we discussed today or overall?
Well, I mean, I don't think I can speak for like how others are underwriting, because I have absolutely no idea how everybody else is underwriting. So what I can tell you is, in the current environment, you need to force yourself to change the way you're thinking about all this. Obviously, there's hype. We've seen hype happen not once, we've seen it many times in many cycles. There's a fundamental shift in how things will work over time. And I think one of the lessons that we can take from before is you don't necessarily need to be the first one in to ride the wave. This is a long cycle that's coming. There's a lot of things happening. You can be a little bit patient. You're not going to miss it. So it's I think it's more about being patient and really having, strong ideas and understanding the fundamentals of what you're going after.
The Apple model.
The Apple model. Although they are a little bit behind on AI, though.
Yeah.
Yeah. Hopefully they'll do something.
Yeah, we'll see. I mean, it's an interesting time to watch, but they certainly have always played. We know them to be first, but we'll do it better.
Well,
One can only hope.
I think patience is a great takeaway from investing in life. So thank you for those closing thoughts. Okay, yes, we have our first question. Please, Deborah.
How much upheaval or turmoil do you think it'll cause in the whole fintech ecosystem with some of the recent meltdowns of sponsor banks and the division of responsibility between fintechs and the banks and the regulatory structures and some of the, introduction of skinny bank charters and all that kind of thing? Any comments on those?
The synapse of all.
That sort of thing.
It sounds and smells like it, doesn't it? It's my opinion that in some ways, this is how things do evolve. We learn from the mistakes. What was wrong with the systems? I think the biggest issue in that particular, in the banking as a service model, if you will, was the lack of having a shadow ledger or sub ledger that was actually monitoring these pooled accounts in real time. That was missing. That technology was missing at the time. I think that system has definitely got its feet underneath itself now. I think it's much stronger. I talk to banks that are much more willing to now get back into the water and look for those relationships and have those types of relationships, because banks are always looking for additional revenue streams, and there was a logical thesis to what they were doing. It was just that we talking about hype, right? Everybody rushed into it. I remember being Money 2020, the year of banking as a service, and everybody banking, they rushed into it. And they didn't figure out the other pieces. Same thing maps to agentic, same thing maps to crypto. It's just the nature of the evolution of technology.
I agree with that. I think over time, you want that to continue building. You want those banks being able to service, because what a lot of these other companies do is they're able to either serve a niche or a particular customer in a way that the bank itself can't. And as a bank, you want to enable those services, and if they can use and leverage your infrastructure, then all the better. So as it evolves, as it finds its feet under it, you want to encourage this, because this allows you to serve the consumers better in a way that they want.
Evolve was a good verb.
Thank you for the commentary. Ron?
I've got a question concerning where you think the money is going to be going over the course of this year. Is the investment dollars going to be going into certain types of infrastructure? You heard from Hans, if you don't have AI, don't even bother coming up to the plate. And is there a type of business line that you think is going to be hotter than others?
So, I think from the AI's perspective, it's, do you know how to use and leverage the tool? Not necessarily is your product an AI product. So that would be the first thing. And then the second one is, I have very, very strong conviction that in the next 5 years, a lot of money is going to go into revamping underlying infrastructure that is behind and cannot keep up with where things are at. And the amount of systems in the world, and the US is behind a lot in the banking world. Everything from core banking, from payment infrastructure, from all of those systems that you have.
Dominance of checks in B2B.
Excuse me?
Dominance of checks still in B2B.
Yes.
all of that needs to evolve because otherwise you're going to be left behind. But the systems that are under it, and we were talking with Michael about this earlier, was you saw a huge wave over the last 10 years. And a lot of the changes and a lot of the businesses were built on this layer. But the invisible layer, all those pipes, all those sewage, all the drainage, everything you don't see, it's still the same. And you need to change that in order to really evolve and catch up. That's why a lot of the stuff in the US and Europe is being leapfrogged by stuff in Latin America. Or in Asia and other parts, there wasn't anything there. So, you kind of are able to leapfrog because you have to build it. But I see, here is where there's a ton of money. A ton. And a ton of money can be spent. And if you're able to start changing those pipes and those foundations, then there's a lot of money to be made.
Yeah, WeChat Pay and Alipay never would have worked if there'd been an entrenched credit card industry.
I'll give you two more, Ron. I think you need to pay attention. I think a lot of money is flowing and being allocated into capital markets technology, especially blockchain, Web3 solutions, tokenization of real world assets, the ability of crypto to be able to fractionalize securities and have them trade 24/7, I think is very real. I think the money that's going into it has been doing so at a steady clip. And then I think the big one that wasn't mentioned tonight was embedded finance. I mean, to me, that is the monster at the moment. It's still, these companies are still getting funded. They're pulling down equity and debt rounds. And, there seems to be, and this goes back to my comment earlier about where the banks yielded ground. These newer fintechs, better decisioning, different products, finding alternative credit signals for underwriting. Embedded finance to me right now, as we're sitting here, is king.
David,
Yeah,
yes.
just a clarification. So embedded finance, is that sort of an extension of PayFacs working with PSPs? So a merchant can just sign up for one thing and get payments embedded, or something different? I want to make sure I follow what you're saying.
It's the embedded systems that at the interface with the merchant and consumer, where consumer can not automatically, but very quickly, with very little friction, secure a credit facility or a credit line, almost seamlessly, and also in the B2B space, you're seeing it as well. That to me is probably one of the more obvious ones. But again, I don't know what that looks like next year, but if we're talking about at the moment, that would probably be at the top of my list.
Sorry, that prompts another question. Where do you think cross-border payments is going to play into this game? Because having done some work there's very low demand in the U.S. market. It's beginning to grow. It needs to be, from what I can see, parsed into certain segments of the industry. But the folks that are entering are having a hard time finding funding. Is it not yet time from a funding perspective, or not so much? There are opportunities.
I think it goes back to Hans. I think mentioned something earlier, and is there really a big enough pain point for that? Unless you have a complex correspondent bank ecosystem where it's a real pain, most of it works really well. So it's really...
Microsoft needs to train overnight. It's like...
it's that, and it's, it's like... Is the incremental benefit that big? And so I think it drives more into, will the financial institutions need some technology to be more efficient, to lower their fees, to do that? But otherwise, we move around money into Latin America, and other places, and
It works through Swift and similar, and that mechanism, which is not really moving money, it's funny money. It's moving money, it's a messaging system, but moving funds real time is still through the old archaic system, and it's going to take a couple of days, and if it has multiple pathways, it's going to take even longer for the funds to get to the person you're trying to pay.
well, they may eventually. You're going to have to move towards that. I mean, we're seeing some interesting things happen. As I said before, like the card schemes are working on how to become more efficient, and they are now using their own rails to move money around, and I mean, we're seeing it. Even though there's a huge use case for their technologies like MasterCard Send, Visa Direct, all these platforms that allow you to send money using the credit card rails. Adoption is slow because it's good enough and it's moving towards it. So I don't see it being a huge space right now.
I would say there's one. There's just one exception there. Wholesale payments, and I'll go back to J.P. Morgan. You are seeing traction there in terms of the tokenized dollar, permissioned blockchain. These are large ticket, low volume transactions that happen overnight. These are repos, treasury management, settlements on large trades. You are seeing traction there, but in that, I guess what we call the classic B2B case that we hear so much, especially in the stablecoin community, I don't see it yet.
Okay, yes, I think we have time for one more question.
My name is Peterson. I'm a financial mathematician. So you talked about not trusting AI, and you mentioned something like that. So I'm currently working on
Could you
AI.
speak up?
Yeah.
Okay. I'm currently working on AI power indices. So what we are doing is that we make the constituent of those indices pass through thorough mathematics before they get to machine learning. So from machine learning, they pass through additional thorough mathematics before they get to AI. Where AI have to make decision, select the best stuff that will make up the indices, right? So, but what we find out is that the worst mistake, the worst decision that AI can make is better. It's better than the best decision that human can make. So, what is your view about it?
Are you talking about investment indexes or?
Yeah, indexes like NASDAQ or S&P. So we introduce AI power indexes. So that pass through thorough mathematics, machine learning, AI have to make decisions to select the best stocks that will fit into those indexes. Right. So what we found out is that the worst decision that AI made is still better than the best decision that human made.
Yeah, so that's a realm where I wouldn't know, to be honest. Say you're talking about quantitative, quant investors or robo. I mean, I wouldn't even call it robo advisors, like quant investment. I mean, listen, I think guys like Jim Simmons at Renaissance have proven that, they can build an incredible machine and clearly outperform everything. And that required, quite an army of PhDs and quite a bit of resources. And, Citadel's doing things that are similar. And so, I mean, can they do? Yeah. I mean, we've clearly seen evidence of that. There's big teams behind it. There's big teams, very sophisticated, very, can a model just build something right now? Like, I don't know. I don't think so. But I mean, if you're doing something that's performing well, then I guess you can keep doing it. I mean, keep going.
I've actually done it actually with that big team. So I would say I tested it for almost like 20 years. I performed all the indexes and it's really amazing. So it's just by restricting AI decision, making sure that the work decision you're going to make is still going to be better than the best decision that human can make. That's based on the formula that we pass through.
That's amazing. Okay, we are at time, so any other questions we'll save for the networking portion of the event. Thank you again, Adam. Thank you, Rodrigo, for this great conversation.